Cathie Wood walks us through several economic charts that explains her view for what might happen in the next year.
Here it depicts the yield curve. It's at the short end of the curve, the 2-year minus the 3-month Treasury bill yield. And you can see this is still inverted, still below zero. And you can see anytime that has happened in the past, certainly for any length of time, we've seen a recession follow. And it has been amazing that we have not been in recession, but as we have mentioned before, we've been in a rolling recession. As the Fed eases, and we do think the odds are 80-90% for a cut on December 10th, this should start moving above zero. And then the longer term yield curve, which I know I talk about all the time, I'm kind of obsessed with it, is I think telling a story. We've put a downtrend here, a trend line, since 2008, 2009. We were surprised during COVID that the yield curve did not reach levels it had reached before when the Fed was fighting recession. It reached roughly half that level. And here we are. Could we be peaking now? Well, that would be very interesting if short rates came down. If short rates and long rates come down, but this yield curve does not steepen anymore, I think it will be telegraphing that there are deflationary undercurrents out there. And hopefully some of the bond strategists will start analyzing it from that point of view as well. Here's just real GDP and productivity. I present this marveling in part that real GDP, the purple line there, the growth rate, has hovered around the 2.5% range in a rolling recession. Of course, government spending and high net worth consumer as stock prices and to some extent bond prices moved up, and housing prices also, existing home prices. So the wealthy have done very well, but the rest of the economy, small business, low, middle income consumers, it is time for them to be able to join this kind of growth rate. And we think that that will happen during the next year. Productivity, roughly a little around 2% in a rolling recession. That's pretty good. If you look back in history, it's stronger than where it's been or where it was during most of the post-global financial crisis period. And we think it's going to continue to move up, as I've mentioned in the past, and perhaps be sustained in the 4 to 5% range, which would be a real breakthrough, being sustained. We got there at the end of the tech and telecom bubble in the late 90s, but it wasn't sustained. I mean, we went through recessions and a pretty bumpy road there. And the next chart here is just a picture of the rolling recession. Manufacturing sector certainly hit. It's been below 50%. Below 50% means contraction. It's been there for about 3 years. It too is, I think, a rubber band stretched and waiting to recover in this next year. Services, as you can see, or the non-manufacturing sector in green, is starting to show signs of life already, and that's probably the first place you see it leading the manufacturing sector.
Cathie is right that the inverted yield curve warned us about trouble, but as rates begin to come down, that warning is starting to fade. When short-term rates stay higher than long-term rates for a long time, recessions usually follow. But once the curve starts moving back above zero, recoveries usually follow. The yield curve simply compares short-term interest rates to long-term interest rates. When short-term rates are higher, it tells us that money is tight, borrowing is hard, and people expect slower growth ahead. That's exactly what we've had for a long time now, and Cathie is right, it's unusual that the economy didn't fully break yet. That's why she calls this period a rolling recession. Some parts of the economy got hit early, others are only now feeling it. What matters most right now is what happens next. Cathie's point is that once the Fed starts cutting rates, short-term rates should fall. When that happens, the yield curve usually moves above zero. Historically, that shift has often lined up with the economy starting to breathe again. That doesn't mean everything suddenly becomes easy, but it does mean that the pressure stops increasing. Businesses can borrow again, home buyers get better mortgage rates, credit card rates stop climbing, people feel less squeezed. Cathie also talks about the longer-term yield curve not steepening much. In plain terms, that means long-term rates are not shooting higher. Falling long-term rates usually points to slower inflation and less economic stress, not more. Cathie says the yield curve is telling a story. We went through the warning phase, now we're nearing the turning point. Not everything is healed, but we're likely moving from damage into repair. Interest rates alone don't tell us if people actually feel better. For that, we have to look at growth and productivity. Productivity is the real engine of future growth, and if it keeps rising, everyday people finally start to benefit. It means how much work does each person get done per hour. When that rises, companies can grow without pushing workers harder. That's how living standards rise over time. GDP just tells us how big the total economy is. It doesn't tell us who is actually doing better. Productivity, on the other hand, shows whether workers are getting more done with the same effort. Cathie's point here is one of her most important ones. If productivity stays weak, growth mostly rewards asset owners. If productivity rises, growth can finally spread to workers. That's exactly what the chart is showing. GDP has been helped by government spending, wealthy consumers, and asset prices, but most small businesses and middle-income households haven't felt that same strength. Now, the hopeful part lies within productivity, and it's already started to improve. That usually happens before wages truly rise and before everyday people feel relief. It's the early stage of a full recovery, not a fake one driven only by debt and spending. In the late 1990s, productivity surged because of computers and the internet. That created higher pay, stronger companies, and broad economic growth. Cathie believes AI is setting up a similar movement now. If productivity keeps climbing, companies don't need to lay people off to survive. They can grow without pushing prices higher. Workers can earn more without inflation eating it away. Cathie also makes an important point about productivity staying near 2% during a weak economy, which is impressive. If it truly moves higher and stays there, it would signal something much deeper. It would mean the structure of the economy is improving and not just bouncing. That's why Cathie sees the next year as a turning point. Now, the final piece of the story is where this recovery starts first, and that's in services, not factories. Manufacturing has been stretched down for years, and when conditions ease, it's possible to rebound sharply. When the manufacturing index stays below 50 for a long time, it signals contraction. When it rises back above 50, it usually marks the start of recovery. Manufacturing has been hurting for a long time now. High interest rates hit factories hard. Equipment financing gets expensive, inventory slow, orders drop. That's exactly what we've seen. Cathie's rubber band analogy is simple and accurate. The longer a sector is held down, the stronger the snapback tends to be when pressure is released. When borrowing gets cheaper and demands return, factories don't recover slowly, they often bounce back fast. At the same time, services are already showing life. This fits past cycles. People often start spending on travel, health, entertainment, and convenience before they start buying new machines and factory equipment. So what we're likely seeing is the early stages of recovery. Services first, manufacturing next. This is also why the economy feels confusing. Some people feel fine, others feel crushed. This mismatch is exactly what a rolling recession looks like. When manufacturing finally turns, that's when job growth usually spreads wider, wages improve in more places, small towns feel it, supply chains pick up. That's why Cathie's optimistic about next year. If you've been wanting to learn AI but don't know where to start, I built a course that walks you through everything step by step, from the basics to deeper concepts like compute and physical AI. Once you join, you get lifetime access, and as we add new modules, the price will rise. So right now is the lowest it will ever be. Check out the link in the description. Most people pour money into ads people ignore. YouTube changes that. It builds trust, authority, and a real connection at scale. One law firm we worked with landed 33 clients in just 5 months, worth $330,000 from their YouTube channel. If you run a business, this is one of the most overlooked opportunities right now. Book a call with me below and I can show you how we can make it happen.